Coming up, BHP tumbles, the ASX falls, and we take a look at the outlook for oil. All of that and more next. Hi everyone, welcome to the SBS On The Money podcast for this Friday, the 19th of June 2026, a day where shares in Australia's largest listed company suffered their biggest fall in more than a year today, sending the share market lower, the ASX 200 down 0.9%. While CSL had a great day along with energy stocks and the supermarkets, BHP was to blame for most of the market's decline, the miner tumbling 5.6%, the most in a year. It follows a cost blowout at its potash project in Canada. But remember, shares in the company are still up a massive 70% over the past year. For a look at the day's market action, a week in review, and including what he's telling his clients, I spoke with Andrew Wielandt, partner at DP Wealth Advisory. Andrew, it's been a big week with two key developments. The first one is the US Federal Reserve pointing to the potential of higher interest rates in the US, but perhaps not until later in the year, and that peace deal between the US and Iran. Which is more significant for investors and why?
Oh, Ricardo, I can't help but smile. Relating to the Middle East, it's been solved. Let's get real. Nothing. All that's happened is we've just really kicked this can down the road 60 days. That's really all that's happened there. So I would think from a market point of view that the market is more interested relating to what's happening with US interest rates. Of course, we've got the new Fed chair, Walsh, there. He's been quite clear that there will be less communication from the Fed going forward, that the previous chairs, Powell in particular, were very transparent, and in particular, he's saying it's almost like a mirror. The market was reacting to what the Fed was saying, and the Fed was looking to the market for signals, and if they weren't getting clear signals. So it's a really interesting 3 to 6 months coming up as to how the market will sort of cope with this lack of information and the Fed being more independent. So I would actually think the direction of interest rates, inflation remains elevated in the US. It's probably a reasonable chance. I think half the governors said that they were think there was going to be an interest rate rise in the US. That's obviously unhelpful for bond yields, and that's therefore unhelpful for tech. And if you look at what's driving markets, in particular the US at the moment, it's actually tech, and their valuations are heavily influenced by bond yields. So in your question, it's interest rates every day of the week.
I find it interesting that they're now not providing any forward guidance, yet when you look at the dot plot, it seems to imply rate rises anyway. Has there been a shift in investor sentiment, or has a lot of that been priced in?
I think so. If I can keep running with the war question that you also asked me, I think one of the reasons, like we had that initial shock, the market fell around 9 to 10% because it's, oh, bother, what's going on here? But very quickly, I think the market sort of came to the view that it was going to get sorted out in some way, in part due to US midterm elections coming in November. So from that point of view, I think the market sort of dealt with the oil price piece. I think where the market, to your earlier question, is going to struggle is where's the direction of interest rates, because there was a view that Walsh was brought in to have interest rates at least steady, if not falling. That was the hope of President Trump, whereas already Walsh is seemingly, on my own person, price stability is our number one concern. And if inflation is going to spike, like here in Australia, inflation will probably get to 5% over the next couple of months because of those elevated fuel prices, then certainly I think the market is going to be sort of taking that in its stride as well.
So in regards to the war, we've seen a big fall in that oil price, I think down around about 10% for Brent crude this week. How's it likely to influence the market and, more importantly, inflation expectations? Because for consumers, it shouldn't just mean good news at the bowser, because it comes just as the government's discount to that fuel excise is about to expire soon.
But will they, won't they, Ricardo? As far as I'm aware, at this stage, like you're right, come 30 June, that excise, it'll go up 26 cents, I think it is from memory. But, who knows? Treasurer Chalmers, rabbit out of the hat. Here's my early financial year present for you. I'll extend it by 3 months. Pretty unlikely. But that is certainly weighing on investors' minds because it's not just the Bowser. I mean, obviously, that's fundamentally important to people like you and I. But there's also that knock-on effect around the transportation piece. And that's why when these fuel prices were going up, it was so insidious. It wasn't just the consumer that was paying it. There was surcharges for transportation providers, obviously the farmers and the impact relating to diesel as well. So I think from a market point of view, again, if we come back to my initial thesis, I think the market always thought this was a short-term proposition. That's why oil, I think at worst, got to about $115 a barrel, not the $150 or $200 a barrel that people were concerned about. And from an inflation expectation, yes, it's baked in for the next 2 to 3 months, but you can starting to see it come off already. No comfort though to the Reserve Bank, because again, the Reserve Bank literally just looks at that inflation number, and if it starts with a 5, they're going to be losing their mind. And even though Governor Bullock earlier in the week said, look, I can't really comment, there is a reasonable chance, not a complete chance, but there is certainly a reasonable chance of one more rate rise. Noting that NAB came out last week and said that they think the rates are on hold, and if anything, it's going to cut. So, I mean, you've been doing finance longer than me. It's a tricky world, my friend. It's a tricky world.
I think you're right. 3 of the big 4 banks say no more rate rises. It's only Westpac that still thinks 2 more rate rises, but then they all think that rates will start being cut sometime in 27, 28. The other thing I want to talk to you about, over the past week, we've done a lot on the likes of SpaceX and the space economy. So I want to ignore that. We've covered that in detail this week, but I want to shift over to resources. The ABS said today that overall profits across all businesses fell last financial year, with the mining sector down the most, driven by reduced global demand for coal and iron ore. However, this data was for FY25. I can't help but feel that it's a little bit dated, because this financial year, we've seen the ASX Materials Index surge around 57% so far, driven by BHP. Incidentally, BHP took a hit today in its share price because of cost blowouts relating to its Canadian potash business. So with all of that in context, what do you make of the sector?
Thanks, Ricardo. Lots to take in there, but at a very high level, yes, with due respect to the ABS and those statistics, it's driving looking through the rear vision mirror. It's all past data. I'm married to an accountant. She loves driving through the rear vision mirror. As a financial advisor, I like driving looking through the windscreen. What's coming at us? It's important to note what's been behind us. It's probably more what's coming at us. So to your point around the market, BHP is around 32, 33% of that resource or materials index that you just pointed out. And it's been on an absolute tear. It was sort of high 40s. It peaked at $65 there till this morning. That cost blowout relating to their potash exposure in Canada, as you just mentioned. But with due respect, BHP have a record of having these cost blowouts as well. And they're not Robinson Crusoe. A number of the other materials or resource companies do as well. And certainly copper in particular, so again, we come back to BHP, copper is around 52, 53% of BHP's total earnings now. It's no longer iron ore. Of course, iron ore for a number of years there. And so as a consequence, this electrification, decarbonisation, demand for data centres, that's going to keep that demand for copper going. That'll be a positive for BHP and a number of other copper providers around the world. And therefore, from a materials index point of view, that should provide support as well. Never mind the fact that it's also still a potentially inflationary environment, and that is also positive for commodities as well. So short term, we're positive on commodities. And bearing in mind the Australian share market's such a heavily concentrated index. It's 3 major miners, 4 banks and 2 retailers. That makes up about 60% of the index. So if banks are under pressure because the housing market is under pressure, and consumer discretionary spending is under pressure because of elevated fuel prices, albeit they are coming off a little bit, resources is probably the only thing that's going to hold the Aussie share market up in the short term.
It's interesting that concentration perhaps is seeing many investors look offshore for opportunities, hence why we saw such popularity from retail investors with the SpaceX IPO. But I guess that's a discussion for another time. Andrew, just in wrapping up, what are you telling your clients right now, and where do you see the opportunities for investors?
Yeah, look, it's so again, as you've probably picked up, I'm sort of cool on the Australian market in the short term for all those reasons. The budget changes, or the first budget, and then the backtracking of yesterday, it still creates a fair bit of uncertainty there. We are certainly more positive on overseas earnings, but without trying to be a Debbie Downer and finishing on a sort of a down note, we are incredibly concerned around tech valuations. I've been doing this nearly 30 years. I know the baby face belies that. And I've never seen such concentration risk in one particular sector. And then if I want to really concern your listeners and viewers on a Friday, it's actually being fueled by credit. So, when this AI boom started, it was actually just equity, and that's unhelpful for shareholders, but the only people who get hurt is the shareholders. Now, around 60% of the funding is now coming from credit. And so when you start adding leverage to the mix, and if all of a sudden there is sort of I don't think demand for AI will go away, but certainly the valuation piece is certainly eye-watering. If some of those valuations start coming back, that is probably the key concern. So more positive on overseas than Australia, but we're acutely aware of concentration risk and that valuation risk with tech. So in our model portfolios, we're underweight tech by about 30% in response to that.
It's Andrew Wielandt there from DP Wealth Advisory, and he wraps up the podcast for this Friday and for the week. Don't forget to give it a review, like and subscribe if you enjoy it. And remember, you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns on Monday. It drops after the market close, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.